My name is James Faulkner. I'm the editor of Master Investor magazine. I'd like to welcome you all to this afternoon's panel discussion. I'm sure many of you are readers of the magazine already, or at least I hope you are. Can we have a raise of hands to see how many people read the magazine? Oh, at least a few, that's good. But for those of you that aren't, do go over to the website and check out the magazine. We do get some excellent feedback from readers. It's written by investors for investors. So do go over, check it out, sign up to the newsletter. And the other thing to bear in mind is that there's no excuse to not do that because it's entirely for free. We're very lucky to have three of our distinguished writers here today as panelists. You might have noticed that we're down by one person. David Jones had to bow out today for health reasons. I was a bit worried that, like the UK stock market, we'd lost momentum, but luckily Tim Price was kind enough to offer to take up or fly the flag for momentum as well as value. So thanks very much for that, Tim. Right, we'll have some brief introductions in just a moment, but I'd first just like to say a few words about today's discussion. As investors, we have certain choices to make about how we allocate those hard-earned savings. Every decision comes with an opportunity cost, and unless we take a passive approach and simply track the market, which is not something that I suspect most people here today would be interested in doing, we tend to adhere to an investing style. And each style has its own devotees, and each style tends to outperform the market at different stages of the economic cycle. So generally speaking, growth and momentum tend to do well in the earlier phase of a cycle, while value and quality tend to perform best in the later stages. In today's panel discussion, we'll hear from proponents of each style, and we'll attempt to work out which style, or indeed combination of styles, looks best placed to outperform in the months and years ahead. Given that we're limited for time today, we'll only be able to give you a flavour of the debate that surrounds this topic, but hopefully that will be enough to encourage you all to reflect on your own investing styles and how they influence your investing decisions, because in the end, it all comes down to what works best for you as an individual investor. Just to say that there will, hopefully be time for questions from the audience at the end, but if you could hang on till then, I'll try and get around as many as I can at the end of the discussion. So thank you very much. So if we can just have panelist introductions, starting with you, Andrew.
Thank you, James. So worked a number of places, actually worked for an MP for a while. I also worked for a fund manager and a stock research company. Now looking to start up my own company called fundhunter.co, which you should have a leaflet about in your bags. And that's researching investment funds and also trying to find the odd stock idea from time to time.
Hello, my name's Tim Price. I'm a fund manager. Been working in the capital markets for nearly 30 years. I'm a value investor, but as James has already alluded, I'm perfectly happy to speak on behalf of Momentum as well.
Hi, I'm Victor Hill. I contribute to the Master Investor blog and to the monthly e-magazine. I had a career in the city, but I actually left the city to set up my own training outfit, which was focused on Russia at a time when it was changing very rapidly. And then I came back into fund management, specifically looking at hedge fund strategies. So I guess, I have a general overview of the financial universe.
Okay, so first question to the panel. Where does the panel think we are in the current market cycle, and what implications does that have for each of the investing styles that you're covering? Andrew?
So we're 10 years in from the last US recession. The bull market is 10 years old. So clearly we're not at the start of the cycle. No one ever knows how long a cycle is because no two cycles are the same. So we're either at the middle or towards the end. What does that mean? Well, as James said actually at the start, when you have turbulence, when you have a recession, quality is the style that tends to hold up and to be resilient. So companies like Diageo, Unilever, they have stood the test of time. They will be able to stand the test of time going forward. And actually, if you look at the Q4 sell-off, we had a bit of turbulence last year. Some of the kind of racier small cap funds lost value, and they still haven't recovered value. Whereas the quality funds like Fundsmith, like Lindsell Train, have already reached new highs. So the time for quality, I think, is now.
What about you, Tim? Because you're a lot more defensive, aren't you? You take a bit more pessimistic view.
Sure, I think my perspective would be, I absolutely agree that it feels late stage in the cycle. The Eurozone is probably about to enter recession. I would slightly challenge the nature of the question, though, because I think central banks have broken the cycle.
Right. Yeah, if you were downstairs just a few minutes ago, Jim Mellon was saying that we're probably much nearer to the end of the cycle than we are to the beginning, and that the warning lights should be flashing accordingly. But I think what Tim just said is absolutely apposite, that I don't think we've got a predictable cycle anymore. And that's largely due to these interventions by central banks who have been addicted to quantitative easing, which is apparently going to continue. We thought that there would be a phase of quantitative tightening, and that was very much the US Federal Reserve's Jay Powell's outlook, and that changed very suddenly for political reasons, essentially. I think all equity investment over the long term is about growth, because we want to grow our assets. Of course, there's an old idea in economics, isn't there, the consumption function. As we go through our lives, different stages of life, we become more oriented towards generating income rather than generating capital gains. And to some extent that's true, but I would argue even quite retired people, even mature investors, are still very much interested in growth, although their timescale may not be so long term. So I think there's a slightly false premise here, because I don't think there's an alternative between either quality or momentum or growth. I think that all three are appropriate to the management of a portfolio, depending on where you are in the cycle, depending on market conditions, and depending on your own particular investment objectives. But I think you start with the premise of growth when you buy equities. Otherwise, you would buy bonds, wouldn't you? I mean, albeit that, with these hyper low interest rates or near zero interest rates, that distinction has been eroded because, gilts are yielding such feeble returns.
Just staying with interest rates, Victor. What implications do rising interest rates have? And I'm thinking particularly about your investing style, Andrew, because a lot of the stocks that we consider to be high quality stocks are also considered to be bond proxies. So with interest rates starting to rise, what implications does that have for the type of companies that you look at?
So I think there's no question that Unilever, Diageo have become more expensive. Unilever's gone from about 15 times PE to about 20 times. Diageo's on about 22 times, and they're not growing very rapidly. And so it's certainly possible that interest rates go up, those PE ratios could come down a bit. But I think that the key thing is that long term, these companies are still good and they're not ridiculously overvalued. Ridiculously overvalued is when you have 40 or 50 times PE ratio. So they're a bit more expensive than they usually are. What matters most, I think, is companies not blowing up. If you have a company blowing up, it's not much fun. And if you read the newspaper every day, you'll find a company blowing up, whether it's one of these retailers that are blown up, keynote. There's blow-ups all the time. The advantage of quality companies is that hopefully they shouldn't blow up because you picked the quality companies. And so even if the valuation comes down a bit, that's less important than their ability to sustain value over the long term.
And what about you, Victor? Because obviously a lot of the growth stocks have been beneficiaries of this sugar rush of quantitative easing and zero interest rates.
Well, first of all, I don't actually think that interest rates are rising. I think they're likely to remain flat for the foreseeable future. I don't see any major change of policy there. If they did rise, by the way, most central governments in the West would go bankrupt in a pretty short order, because the level of debt that they're sustaining is such that if interest rates went back to 5%, the interest bill would be simply unaffordable. That's an aside. You see, I don't think that there are, as we used to think, growth companies and mature, stable companies. The old idea was that you had growth companies which didn't pay dividends, and you have mature, established companies with low earnings volatility which pay dividends. And I don't know if you go. I don't know how many of you went to business school, but if you go back to the 1980s, remember, Tim, the BCG matrix?
Something like that.
Cash cow,
Cash cow,
growth thing,
stars,
Growth Star, yeah.
the
Growth
dog.
Star. The dog.
What
What was the fourth one?
was the fourth one? Someone
Someone
you can help
Google
us.
it, please, if you.
BCG matrix. And everyone took this as sort of a doctrine, which was, you know, revealed truth. But in fact, you have quite mature companies which are nevertheless growth stocks. And I could finger, for example, Microsoft, which is paying a dividend. It's still growing very rapidly. And does anyone know what the PE of Microsoft is as of yesterday? Because I don't check these things regularly. But you know, the technology stocks, I mean, Jim is very bearish on technology overall, the FANGs. I don't know what Tim's view is. I think you're also bearish.
Probably, yeah.
You know, these are growth stories, by and large, even though they're enormous. They're very, very large, and you know, they are producing huge amounts of cash flow, and in many cases they're profitable, but they're still growth stocks. So the idea that, you know, you go for startups, which are risky, yes, as you say, but the risk should be priced in. I mean, the risk is reflected. The default risk, the collapse risk, should be priced into the return.
That's what people say, but unfortunately, if you look at early stage investors, it doesn't seem to be like for instance, the AIM index, which is high risk early stage companies. In 1996, it started at 1,000. Today, it's 900. So you don't get any dividends. So being in these early stage companies, unless you've been very selective, actually hasn't done you many favors. So it's quite to me, it's quite counterintuitive. But if you look at a book, What Works on Wall Street, the guy there, James O'Shaughnessy, did a study of 30 years, I think, US data. 50, sorry. And the best performing sector was consumer staples, which are things like Kellogg's cornflakes. And you think, how can that do well? Well, it's the ability to not go bust, which sounds, pretty obvious, but a lot of companies do go bust. And then just produce that steady growth, good cash flow. Probably it's not the best sector now, but
branded products, right?
Yes, branded products that are going to stand the test of time. Franchises in other areas as well. So yeah, I guess that product where you think, I can't negotiate with this product because there's only one product.
Talking about the data to back these investing styles up, Tim, you've got some interesting data on the efficacy of using a momentum strategy and a value strategy.
Well, I've been triggered now that James O'Shaughnessy has been credited. So there was no collaboration between the two of us before the panel, by the way. So my very first stat is from What Works on Wall Street, which is a book by James O'Shaughnessy that came out earlier in the millennium. This is my favourite stat this is my defence of value investing in a snapshot. So what O'Shaughnessy did was he took a portfolio of 50 stocks, the most expensive stocks from the US market and the cheapest stocks from the US market by a variety of metrics, price to book, price to sales, price to earnings, and so forth. And then he simply replaced those 50 stocks every year or over a course of 50 years. So to put some flesh on the bone, if you started out with $10,000 and you put that money into the highest price to book stocks in the US market, your $10,000 would end up being worth $250,000. And you think, well, that's pretty good, isn't it? Until you realize that if you'd put your $10,000 into the lowest price to book stocks, you'd have had 22 million after that 50-year period. The stats in favor of value over the long, what I would call value over the long run, it's the best performing strategy by miles. To an extent, this is a slightly false debate because value, growth, momentum, quality, they mean different things to different people. So they are somewhat subjective. They're quite porous as definitions. But I would define value effectively as not consciously overpaying for a decent business. That's certainly what we endeavour to do in our business. And the only other stat, and I'll wrap up, the only other stat I'd add, there's a very good piece of research from a company called Research Affiliates, it's a fund management shop run by Rob Arnott in the US. And the piece in question, it's online, you can read it for free. It's called something like How Not to Get Fired by Using Smart Beta. So it's got a slightly weird title, but it's basically about 2 years old now. But I'll happily share the information with anybody. But he crunched the numbers, again, 50-year period from 1967 to 2016. And he broke the US market down into value, momentum, quality, and growth. And over that 50-year period, the best performing strategy was, any guesses? Value. And the second best performing strategy was, any guesses? Momentum. Momentum, funnily enough. And astonishingly, and this is where the definitions clearly matter, the third and the fourth strategies lost money relative to the index. So both quality and growth, by research affiliates definition, actually ended up doing worse than you would have done by owning an index.
But to play devil's advocate though, Tim, value has underperformed now, hasn't it, for quite some time, whereas growth and momentum have both done really well over the past
That's true.
years.
I wonder, it's certainly true that value's been out of favour for a while. You've made money, but you just haven't made as much money. But it kind of depends what your benchmark is. For me, we were talking about this before we came on air, for me, the most important benchmark is basically an absolute return one. As private investors, you don't need to benchmark to anything. You don't have to be benchmarked to the MSCI World or the FTSE. What I'd suggest is you benchmark to inflation plus, because that's something you can take to the bank. The problem by benchmarking to any kind of arbitrary index is 2 years out of 5, you're going to lose money. So I think that's really where it comes, where these sort of definitions kind of come to the fore. It's what's your objective.
So when we're talking about value companies, what type of companies are we talking about? Because obviously, what springs to mind is companies on a low PE ratio. But one person's value company might be another person's poor quality company.
Sure.
So how do you look at that?
This is my own definition. I'm motivated almost entirely by what Benjamin Graham wrote in the Bible for value investors, which is The Intelligent Investor, published in 1949. And sort of taking a kind of slightly modern Ben Graham approach, value for me would be it's sector agnostic, but you want quality management. People who've delivered the goods to shareholders over a considerable period of time. And then you have sort of hard metrics like relatively low PE. We'd never pay more than 15 times PE for anything. Relatively low price to book, ideally less than 1 if it's available. That clearly doesn't help in technology stocks because they'll never get that cheap, and price to book is an imperfect metric for assessing them anyway. But these kind of hard metrics overlaid with a kind of quality threshold. But the best way I could describe it would be not consciously overpaying for good companies.
Tim, where do you stand on, say, the UK house builders, which are trading on ridiculous, very low PEs right now?
The most honest answer I could give you is we run a global unconstrained value fund. We do not currently own any UK stocks. Now that's not a judgment call on, or including the house builders or the banks. That's not a judgment call that the UK market is bad or particularly expensive. I don't think the UK market is particularly expensive. It's simply a reflection of the fact that by our definition of value, we can find compelling valuations in Asia, particularly Japan, particularly Vietnam. We don't need to touch other markets or other sectors in the UK if we can get stunning enterprise value to cash from operations metrics in the fastest growing sector of the world, which is called Asia.
So the same question to you, Andrew.
Yeah.
How do you define a quality company?
The good thing about quality is you can really, really strictly define it. So the general definition is a return on capital employed. So all the capital that's been given to the business, debt and equity, over 15% over the cycle.
Which kind of rules out a lot of companies, doesn't it?
Yes. So there's very few companies that A, can get a high return, and then B, can sustain a high return. So those two things are very, very hard because many companies, they can get a high return, but they can't sustain it. So, just coming back to what you were saying before, you can't really necessarily say a company is quality on the basis of the data today because what you're concerned about is whether the return on capital will hold up over the long term, which is a judgment call. So companies that have generally had good quality metrics in the past will tend to be good, but like newspapers or whatever else, that changes. I think that the real challenge for me personally with value, I think we all want value, I agree with, but given disruption and these very big changes in the economy, I think value is under threat in a way that has never been before. So you've got Marks and Spencer's, where people say this is cheap because it's 7% yield or whatever it is. But the long-term trends are not in favour of Marks and Spencer's and these other kind of value stocks. To give a kind of going back further, an example, people thought, I think Borders Bookshop was listed at one point. So this is really good value, Amazon's too expensive. Well, Borders Bookshop is now bust, and Amazon is I think the third largest company. So I think that the reason value hasn't worked, perhaps, recently is because of these disruptive trends, and I'm not really sure they're going to change. So it seems to me a style that is potentially under threat, unless you think a company can compete with Amazon or can compete with Google. Whereas I think that, personally, in my opinion, quality can never be under threat, because quality is the factor that allows you to compound value. If a company has quality, it's low risk, so it shouldn't go bust. If you combine it with growth, it can compound. But I think, just to say, as Victor was saying, all these styles are important. It's the question of how you prioritise them, which is the first thing. For me, quality is always first. Sorry.
Andrew, you mentioned two sectors there, newspapers and retail. And historically, you can look at a Marks and Spencer's or a Trinity Mirror, and you can show that they had very steady earnings and very steady dividend payouts, very low earnings volatility. And then suddenly, you realise the world is changing. People aren't buying newspapers anymore. They're getting their news online. So the very market which has actually generated these sustained incomes over time is disappearing. So this is the problem. Quality can go away.
Just to pick up on that point, though, Victor, technological disruption. Obviously, it's happening so quickly now that it's difficult to kind of pick winners within those sectors. How, as a growth investor, it's all about picking winners, isn't it? Because you either win or you go bust.
Well, I think
how
it's
do you
about
mitigate those risks?
I think it's about picking a compelling story, because you never know whether that technology is actually going to flourish in the end. So we've just had a discussion about Tesla. Evel Knievel and Jim Mellon are shorting Tesla. But there's a lot of people who will tell you Tesla is, the Amazon of the future. If they can get the price of their cars down to the equivalent unit cost of a conventional internal combustion engine car, they're going to be a massive entity in years to come. So, I'd like to know your view on Tesla, because it divides opinion.
Me?
Well, but
Oh.
all.
I mean, I personally, I'd probably put Tesla in the too hard category, because could it be a winner? It might not be a winner. It's a bit like one of those companies that comes on Dragon's Den. You're not quite sure if it's going to make it. I actually spoke to Bally Gifford about it, and they get the most questions about that company. But there's no question that if there was a big downturn, Tesla could be bust in a year's time or 2 years' time. So to me, it seems like a tough.
So why does it have a bigger market cap than GM?
So it's a concept stock run by a madman.
I mean,
a very good sales madman.
I do admit there are corporate governance issues.
Right, I think we're going to have to take some questions from the audience, because I'm conscious that Victor's got to run off in a minute.
30. Thank you. So, not as high as Amazon then?
So they got the guy?
Yep, the gentleman over there.
The three measures you talked about are fairly normal. It doesn't take into account unicorn stories, but surely the price of any share is the price that somebody's prepared to sell it for, or the price that somebody's prepared to buy it for. So whatever reason, whether it's momentum, whether it's a story, whether it's dividend and long term, whether it's funds who actually bought large numbers of shares, the measures you've been talking about, is it worth looking at the whole thing from what is actually the supply and demand of shares and assessing the value from there? And what is the rationale? I mean, Twitter, whatever its price, still not making a profit, but the valuation is $100 per subscriber. So the way you evaluate this is quite different.
I think growth investors, they look at the potential what can be I mean, a lot of quality investors, including myself and value investors, dismissed Amazon. Whereas coming back to what you were saying, that the growth investors saw that potential, they were willing to pay for it, and it has delivered. So I think there's something to be said. There's something to be said for growth investing to kind of assess that potential. And as you're saying, if people are willing to pay that much for Twitter, maybe it can realise that potential. But growth investing is quite a hit and miss and fair. Some companies do make it, some companies fail. You've got to get those odds right. This would be my...
I think the way I'd respond to that is these are all somewhat arbitrary labels for just divvying up the market. So some stocks will naturally fall into one category and some into another. I think the trick as an investor is to try and find a style or probably a number of different styles that you can live with psychologically easily. I think the worst thing, the most difficult thing is trying to say, look, I want to be in X, Y, Z, when it goes against all your natural inclination. I like value on my terms because I'm willing to be patient, I'm willing to be contrarian, and that's basically it. And also I'm very conscious, I don't want to overpay for stuff. I like a margin of safety, particularly at this late stage in the cycle. So it suits me very nicely. I sleep at night quite well pursuing this strategy. But other people who have got a slightly higher appetite for risk might well be natural momentum or growth investors. And that doesn't mean any of us are wrong. It's just kind of horses for courses. But I think the issue, what it really ought to come down to is, the stock market will always be a risky place. I think it's about finding an approach to live within it that appeals to your own sensibilities, but also gives you as much skin in the game as you can find.
More questions? Gentleman at the front.
You mentioned Asia, and if you go for value, you sort of get the growth of Momo free because these economies are growing at 7% of things.
Yeah.
Two things, because leave currency aside for a moment. What about governance and reporting? We saw that NIO, the Chinese Tesla, basically lied on their forwards, and the shares dropped 30%. Yeah. So I see fantastically low PEs in China, India, and Southeast Asia. But can I trust the governance?
It's a fair point. I mean, we invest in our second largest holding in the fund after Japan is Vietnam, and we met Mrs. Hang, who's the CEO of Saigon Securities Asset Management, and we raised the issue of corporate governance. And she said, it's about 2 or 3 years ago, she said they had a case of a local bank manager who was found with his fingers in the cookie jar, and they executed him. Now, I think we could do with some of that corporate governance over here. To go back to the point, I'm not being overly cynical. The issue is, where's the corporate governance in the UK? Because we've just had a referendum, the biggest vote for anything ever in our country's history, and it's not going to happen because the government doesn't want it to happen. Well, I'd say that's a pretty big failure of corporate governance.
Yeah, but you know what I mean.
It's all a relative game.
Let's throw the second bit in. So, CNY, not too bad, fairly stable against the dollar growth rate. They own the dollar. But Indian rupee, although you could get 7-8% growth in GDP and 7-8%
The Vietnamese dong is different because it's run a bit like the Singapore dollar as a trade-weighted basket against its trade competitors. But we don't invest in China. We haven't found anybody in China, a manager in China, because we wouldn't pick stocks there. We haven't got the skill set. But corporate governance is a big deal. We met a Hong Kong manager, and he said, if there's 1.3 billion people in China, assume 1 billion of them are crooks. So these are live concerns. I absolutely agree.
Are they any better if they're
Sorry, I'm just going to go to the gentleman over there at the back.
Thank you very much. My question follows on from the point that we're perhaps now in a world that it's no longer either or, growth and value, established and up and coming. What would you be worried about or not about the level of emphasis in a lot of what you might call retail advertising and punditry in the press about the search for income? Because I'm not so much partly thinking about the levels of income that are being mentioned, but also the sheer frequency it comes up.
I'm going to let Andrew
I,
pick on that one.
I think that, well, firstly, I think you're absolutely right, because the last financial crisis, why did it occur? In large part because all these bad mortgage bonds were put together to generate income because pension funds couldn't get enough income. So the search for income often leads to these huge disasters because things get manufactured to be income when they're not sustainable. And we had that recently here with this London capital something that blew up. So yeah, I think the search for income is very dangerous. I think people should only look at the total return. And your question really is asking, we want to be in things that don't blow up, which thankfully supports my case for the quality, because the whole point of that is it shouldn't blow up. And coming back to what Victor was saying before, you're right, quality in the past is no guarantee of quality in the future, but that's what you've got to assess. Because there's no point buying a company unless it's going to remain good quality, because then there's just no point. So I think the search for income could cause another disaster, absolutely.
Any more questions?
Just one, going back to corporate governance, do you think that there's real improvement likely to take place in Japan?
Yes, I think Abenomics is for real.
But in terms of corporate governance in Japan?
It's starting to happen. So one of the big problems in Japan has been that businesses have been run for the benefit of senior management and not for shareholders. That is finally starting to change. For sure, there's always the outlier. And so I'm not saying Japan is sort of the panacea, but all the evidence that we've seen on the ground with managers that we invest with is that commitment to shareholder returns is there, commitment to shareholder value is there, buybacks are going up. Japan is probably the lowest rated market for overall return to shareholders. That ratio is only going to go up, whereas in the States it can only come down.
Time for one more question.
Can I just add, corporate governance is one thing, and you can take people out and shoot them, which may or may not improve the overall level of corporate governance, but transparency is another. And where there is a more transparent society, you will find that corporate governance is enhanced because people who are on the make will be found out. So I think, when we look at it, I'm sure that this is something that bears in your calculations in Asia, that Japan is a more transparent society than China.
Sure, absolutely.
Gentleman at the front.
In terms of value or momentum, do you have any tips?
My website lists stocks I've covered in the past, fundhunter.co, and I'll probably cover some in future. And I used to write for Cube, but yeah, Fund Hunt. I mainly cover funds, but there's some companies on there. If you go to stocks, there's a section just on companies. Any tips from you guys?
From my perspective, if you want to look at what we own, our major holdings of the fund are on our website, Price Value Partners. Have a look, see what we put our money where our mouth is.
And you can follow Victor's comments on Master
Oh,
Investor.
and in the Master Investor magazine, for example, just talking about quality, I covered 6 companies that are in the Smithson Trust on page 76 to something else. That's interesting, I think.
Right, I think we're going to have to wrap it up because Victor's got to
Thank
be
you,
somewhere
James.
else.
Thank you.
So thank you very much, everybody.